Caesars Palace does not own Caesars Palace. VICI Properties does. The deed is in VICI's name, and Caesars Entertainment pays VICI more than $1 billion a year in rent on buildings it once owned outright. The mechanism that produced this started with $30.7 billion. In January 2008, Apollo Global Management and TPG Capital bought Harrah's Entertainment and financed the purchase with debt, using the casino buildings as collateral. When the operating subsidiary filed for bankruptcy in 2015, the real estate became the restructuring currency. By 2017, the buildings had transferred to VICI Properties, a real estate investment trust created to receive them. The rent runs on long-term leases and does not adjust when business slows. Every dollar Caesars pulls in runs through a balance sheet that pays VICI first. 3 questions matter: how this structure was designed, who profited from building it, and what it costs the guest every time they check in. On August 5, 1966, a developer named Sarno opened the most theatrical hotel in Las Vegas. Caesars Palace cost approximately $25 million to build and had 680 rooms. Sarno's concept was Roman opulence at a scale no hotel had attempted. Marble floors, fountains modeled on classical statuary, dealers in togas. Sarno dropped the apostrophe. The name was Caesars, as if every guest was already the emperor. That framing lasted for 6 decades. By the late 1980s, Caesars Palace was the address that mattered on the Strip. It hosted the fights Dave watched on pay-per-view. The Hagler-Hearns undercard in 1985. The Sugar Ray Leonard comeback in 1987. The casino floor covered 130,000 square feet at its peak, one of the largest in the world. A guest walking through the lobby in 1992 had every reason to believe this place would always be exactly what it appeared to be. The company that owned it would always own it. The entity that held Caesars Palace through most of its history was Harrah's Entertainment. Harrah's was not a small operator. By 2007, it was the largest casino company in the world by revenue, reporting more than $9 billion in annual revenue across more than 40 properties. The portfolio included Paris, Las Vegas, Bally's, Flamingo, Rio, the original Harrah's locations, and Caesars Palace as the crown asset. Its properties stretched from Atlantic City to the Gulf Coast to the Nevada desert. After Hurricane Katrina hit the Gulf Coast in August 2005, Harrah's rebuilt its damaged properties and kept them running. The credit cycle in 2006 and 2007 was generous to companies of this scale. Harrah's carried manageable debt relative to its cash flow. It looked like the kind of company that absorbs whatever the market throws at it. The sensory memory Dave carries. The sound of the Caesars casino floor in the 1990s. The particular pitch of slots at Full House. The carpet designed to keep your eyes off the exits. The ceilings high enough that you were not quite enclosed. You could spend an hour in that room and feel like you were somewhere important. Whoever owned this place was permanently in power. In 2007, Harrah's Entertainment operated the most recognized casino brand in the country and looked like the kind of institution that does not collapse. 7 years later, its operating subsidiary would file the largest gaming bankruptcy in American history. The papers that started that sequence were signed in January 2008. A leveraged buyout works like this. You borrow money to buy a company, and you put the company's own assets up as collateral for the loan. The company you bought is now responsible for paying back debt it did not incur on a purchase it did not make. In January 2008, Apollo Global Management and TPG Capital applied that structure to Harrah's Entertainment. The deal closed on January 28, 2008. Total enterprise value: $30.7 billion. Apollo and TPG contributed a fraction of that in their own equity. The rest was debt, secured primarily against Harrah's casino properties. At closing, the subsidiary that would become CEOC, Caesars Entertainment Operating Company, was carrying approximately $16.7 billion in borrowed money. The timing problem was not visible on January 28th. Las Vegas was still posting strong occupancy numbers. The Strip was booked. The financial crisis had not yet registered on the casino floor. Bear Stearns would collapse 2 months later in March 2008. Lehman would follow in September 2008. By the time the crisis was fully visible, Apollo and TPG had already signed the papers on the largest leveraged casino acquisition in history. Private equity firms do not buy companies to hold them permanently. The standard horizon is 5 to 7 years. You acquire, restructure for efficiency, extract management fees and dividends along the way, and exit when valuations recover. The problem with Harrah's was that the debt load was so large that it consumed the cash flow the company would have needed to sustain those operations through a recession. Interest payments on $16.7 billion at the rates available in 2008 ran into the billions annually. Casino revenue, even at Caesars Palace, could not pace that. The model required the economy to cooperate. It did not. The financial crisis arrived, the exit window closed, and the debt that made the deal possible became the mechanism that made the company's survival impossible. The sensory reality of the Strip in January 2008. Nothing visible changed. The fountains ran. The neon was on. Guests arriving for weekend trips were not carrying any information about the deal documents signed that month in a private equity conference room. The machine was running. The paperwork underneath it was not. CEOC closed with $16.7 billion in debt in January 2008. By the time it filed for bankruptcy 7 years later, that number had grown to $18 billion. What happened in between is the story of a balance sheet that was designed with no margin for error in the market it was entering. The interest math was the first problem. On $16.7 billion in debt at the rates CEOC carried, the annual interest obligation ran north of $1.5 billion. Caesars Palace was one of the most profitable casino properties in the world. It was not generating $1.5 billion a year in free cash flow by itself. The portfolio of 40-plus properties produced that cash collectively, and it was barely enough, and then the financial crisis arrived. The years from 2008 to 2012 were the worst period for Strip revenue since the aftermath of September 2001. Las Vegas visitor volumes dropped, average daily rates fell, and casino revenue contracted across the Strip. CEOC was trying to service a debt load designed for a rising market through the sharpest hospitality recession in a generation. By 2012, the creditors started moving. Unsecured bondholders began filing lawsuits challenging how assets were being managed and transferred within the CEOC structure. The argument was that Apollo and TPG were moving valuable assets away from the entity that owed the debt, leaving the creditors with less to recover if the company failed. The legal fight over CEOC's assets started in 2012, 3 years ahead of the bankruptcy filing. 2013 brought another round. CEOC attempted to spin off certain real estate assets into a real estate investment trust structure that would have separated the buildings from the operating debt. The creditors sued to block. They argued that the real estate was the only collateral backing their bonds, and moving it out of reach was the kind of maneuver that happens when insiders know a bankruptcy is coming. January 15, 2015, CEOC filed. Chapter 11. Bankruptcy in the Northern District of Illinois, Chicago. The filing listed approximately $18 billion in debt. It was the largest gaming bankruptcy in American history at the time. The filing named more than 170 subsidiaries. The court battle over creditor recovery would run for more than 2 years and produce thousands of pages of filings documenting how the company had been managed in the years leading to the collapse. The Caesars Palace casino floor was open on January 15, 2015. Dealers were working. Slots were paying. The morning shift at the main casino had no visible indication that the parent entity had filed in a Chicago courthouse hours earlier. The building operated exactly as it always had. The difference was, now under a judge. By 2015, CEOC had gone from $16.7 billion in debt at closing to $18 billion at filing. The assets were the casino properties, and the restructuring plan was about to decide which entity would hold them. Chapter 11. Bankruptcy is a legal process that lets a company restructure its debts while staying in operation. Creditors receive a reorganization plan that tells them what they will recover and in what form. Some get cash, Some get equity in the reorganized company. In CEOC's case, what the restructuring plan decided was more fundamental than a payment schedule. It decided who owned the buildings. The restructuring plan separated the operating business from the real estate. On one side, Caesars Entertainment Corporation, the company that would continue to run the casinos. On the other side, a new entity created specifically during the restructuring to receive the real estate. That entity was called VICI Properties. VICI Properties Inc. is a real estate investment trust. A real estate investment trust is a company whose primary business is owning property and collecting rent from tenants. VICI does not run casinos or employ dealers. It holds the buildings and collects rent from whoever operates inside them. VICI was incorporated to hold the casino real estate that Caesars had built and operated, and to collect rent from Caesars as the new tenant. CEOC formally confirmed its restructuring plan on August 3, 2017, and emerged from bankruptcy on October 6, 2017. At that point, the deed to Caesars Palace, to Paris, Las Vegas, to Bally's, to the Horseshoe Properties, transferred to VICI Properties. Caesars Entertainment signed master leases, some running 35 years or longer, agreeing to pay VICI rent on those buildings for decades. The rent Caesars pays VICI runs between $1.1 billion and $1.3 billion per year, a contractual charge that does not decrease when occupancy falls, does not pause when the economy contracts, and shows up on Caesars' income statement every quarter. Stand outside Caesars Palace today. The fountains that run in the front court, the Roman columns lit at night, the guests arriving by car under the same portico Dave has seen in photographs since 1966. The name on the sign says Caesars. The deed on file with Clark County says VICI Properties. J. Sarno built this place in 1966 and owned every stone of it. In October 2017, the deed transferred to a company that had not existed 3 years earlier. The lease terms VICI, locked in 2017, run through 2052. Every economic decision Caesars makes on the Strip between now and then runs through a rent obligation that does not adjust for how the decade goes. The most common explanation for what happened to Las Vegas is the simplest one. The executives chose greed. They raised the resort fees because they could. They eliminated the cheap buffets because they wanted more margin. They priced out the working class guest deliberately, as a decision made in a boardroom by people who stopped caring about the customer. That explanation is wrong, and the reason it is wrong is sitting on Caesars' income statement. The VICI rent obligation runs between $1.1 billion and $1.3 billion per year. That is a fixed charge. It is not discretionary. It is not something Caesars CEO Tom Reeg can renegotiate based on how the quarter went. The master leases signed in the 2017 restructuring run for 35 years or longer. They are structured as triple net leases, meaning Caesars pays not just rent, but also property taxes, insurance, and maintenance on the buildings it occupies. Caesars carries all the operating risk. VICI collects the rent regardless of how the casinos perform. On top of the VICI rent, Caesars Entertainment carried approximately $12 billion in its own operational debt as of 2024. Annual interest on $12 billion at market rates adds several $100 million more to the fixed cost structure. By the time Tom Reeg makes a decision about staffing levels, room rates, or the price of a cocktail, the balance sheet has already committed more than $1 billion to VICI and several hundred million to debt service. Tom Reeg addressed his strategy on the first quarter 2023 earnings call, May 2, 2023. He said, "You're bringing in higher value customers and you're already full, so you're kicking out the lowest end. I see no reason that needs to or would stop." He is not describing a preference. He is describing the arithmetic of a balance sheet that Apollo built in 2008. A company carrying this fixed cost structure and this rent obligation cannot make the economics of $30 rooms and $8 prime rib work and survive. The pricing model changed because the balance sheet required it. If you have paid a resort fee in the last 5 years, Reeg is describing your check-in. Dave's $50 resort fee did not appear because a CEO sat in a boardroom and decided to be cruel. It appeared because the line item on VICI's invoice had to be covered every quarter. The CEO running Caesars today inherited the structure, and the fee is what the balance sheet requires. Tom Reeg is running the machine Apollo built. The second explanation Dave hears is the technology argument. Younger people are gambling online. The generation that would have come to Vegas is playing poker on an app instead. The brick-and-mortar casino industry is a sunset business, and the Strip is just the most visible proof. That argument does not survive contact with the data from the same Strip it is trying to explain. Las Vegas Strip casino net income dropped 40.4% in 2024, in the same year that Strip revenue increased 6.2%. Revenue went up. Net income collapsed. That is not what a dying market looks like. That is what a company looks like when its fixed costs are eating the margin generated by every additional dollar of revenue. The market is not contracting. The cost structure is consuming the output. Local casinos in Nevada tell the same story in reverse. Station Casinos, which serves Nevada residents rather than Strip tourists and does not carry an equivalent debt or rent structure, has posted revenue growth through the same period that Strip operators are struggling. The customers priced off the Strip are not logging on to gambling apps. They are driving to Henderson and Summerlin and the locals' properties that still offer them reasonable table minimums and a restaurant that costs less than a car payment. The pattern is consistent across every private equity-backed casino company that went through a similar leveraged buyout cycle in the 2000s. The operators that did not carry those debt structures are doing fine. The ones that did are the ones raising fees, closing amenities, and targeting only the high-spend customer. That is not a market development. It is a balance sheet consequence applied uniformly across an industry segment. The Mirage Volcano ran free of charge from 1989 to 2024. It drew crowds from the sidewalk. Those crowds walked into the casino afterward. The attraction paid for itself in foot traffic many times over its operating life. It was demolished in August 2024. The footprint it occupied on the Strip now carries the same VICI rent as premium hotel rooms. A free volcano produces no direct revenue. A hotel tower does. That math was not driven by a technology shift. It was driven by a rent obligation that charges the same rate for every square foot, whether the square feet are generating revenue or drawing a crowd for free. The Strip is not losing to the internet. It is paying for a deal signed in January 2008. Apollo Global Management is a publicly traded company on the New York Stock Exchange, ticker APO. As of 2024, it manages more than $600 billion in assets across credit, private equity, and real assets. Co-founder Mark Rowan has led the firm since 2021. Apollo is not a distressed firm. The Caesars deal went wrong for the creditors, not for Apollo. In the years leading to the January 2015 bankruptcy filing, CEOC paid Apollo hundreds of millions of dollars in management fees. Apollo did not conceal them. The bankruptcy proceedings documented every payment, and the unsecured creditors, the bondholders, and pension funds and suppliers who had extended credit to CEOC found those fee payments in the court record and argued they represented value moved out of the company in the years leading to the filing. The bankruptcy court put the extraction history on the record. Apollo and TPG had substantially reduced their equity exposure in Caesars Entertainment by the time CEOC filed. The bankruptcy crystallized what remained. The creditors, the ones who had lent money to CEOC based on the premise that those casino buildings were the collateral, were the parties who spent years in the Chicago bankruptcy court fighting for recovery. Apollo was an observer by then. VICI Properties today is one of the largest REITs in the United States. Its tenants include not only Caesars but MGM Resorts Properties, Hard Rock Hotels, and others that followed the same real estate separation model. The bankruptcy that created VICI in 2017 from CEOC's restructuring became the template for how casino real estate operates now. VICI's market capitalization has grown into the tens of billions. It pays quarterly dividends. Caesars Palace is a tenant of VICI Properties, which trades on the New York Stock Exchange. Dave can open a brokerage account and buy shares in the company that owns the building he walks into when he goes to Vegas. The entity that owns the fountains and the columns and the carpet under his feet is publicly traded at around $30 a share. The casino that charges him a $50 resort fee is paying its landlord, and the landlord is available for purchase on any trading day. Apollo bought Harrah's Entertainment in January 2008 for $30.7 billion financed with debt. CEOC filed for bankruptcy. VICI Properties, born from that bankruptcy in 2017, now holds a portfolio of gaming real estate worth tens of billions and pays quarterly dividends to its shareholders. Go back to Caesar's Palace. The fountains in the front court, the same ones that ran in 1990, are still running. The columns are still lit at night. The name on the sign is still Caesar's. From the outside, nothing visible has changed about the identity of the place. What changed is the balance sheet behind it. In January 2008, 2 private equity firms signed paperwork in a conference room. That paperwork loaded $16.7 billion in debt onto a casino company, put up the buildings as collateral, and set in motion a 7-year sequence that ended in a Chicago bankruptcy court. When the court finished its work in October 2017, the deed to Caesar's Palace was in VICI Properties' name. Dave's resort fee, the $50 he pays at check-in on top of the room rate he already paid online, is a downstream consequence of those January 2008 papers. The $50 resort fee, the Bacchanal Buffet closed in 2020, the Mirage Volcano demolished in August 2024, all traced to a balance sheet carrying more than $1 billion in annual rent to VICI and hundreds of millions in interest, with no economic room for amenities that cost money and produce no direct revenue. The commenters who said they broke the compact with the common man were right. They just had the wrong cause. The compact was not broken by management drift or corporate indifference. It was broken in a conference room in January 2008, when 2 private equity firms borrowed $16.7 billion against the casino buildings and left the operating company to service that debt through whatever markets came next. The terms of that deal are still running. VICI's lease does not expire for decades. The check-in receipt 17 years later is the first installment, not the last. Caesars closed every one of its Las Vegas buffets in 2020. The Bacchanal Buffet, the Paradise Garden Buffet, all of them gone. And Caesars announced they would not reopen. Every major casino company that went through the same private equity debt structure made the same call at roughly the same time. The math on why traces directly to the same 2008 deal and the same rent obligation. That is the next one in. The name on the door is Caesar's. The landlord collecting the rent is VICI Properties. The guest paying both of them is you.